Mutual funds can be a great investment option for beginners, but they can also be overwhelming. In this video, I am going to show you what mutual funds are and how to invest in mutual funds. You will also learn about the benefits and risks of investing in mutual funds, among other things. There are a lot of different funds to choose from, and each one has its own investment strategy and asset allocation. And fees can vary widely from fund to fund, so it's important to understand them before you invest. First, let's look at what mutual funds are. Mutual funds are a type of investment that allows you to pool your money with other investors and invest in a variety of assets, such as stocks, bonds, commodities, and real estate. A professional fund manager invests your money and makes decisions about which assets to buy and sell. You can buy shares in a mutual fund, which represent your ownership in the fund's assets. Mutual funds are designed for long-term investors and are not meant to be traded frequently due to their fee structures. Before I continue, if you're new here, please hit the subscribe button so you make sure to never miss my weekly videos on wealth creation tips. Mutual funds are attractive to investors because they offer diversification and liquidity. Diversification is the practice of investing in a variety of assets to reduce risk. Mutual funds offer diversification by investing in a variety of assets, such as stocks, bonds, and real estate. This helps to minimize the risk of any one asset losing value. Liquidity is the ability to buy and sell an asset quickly and easily. Mutual funds are liquid. It is easy to buy and redeem shares in mutual funds. There is a wide variety of mutual funds to choose from, including bond funds, stock funds, balanced funds, and index funds. Bond funds invest in bonds, which are loans that are made to companies or governments. The interest payments from the bonds are then distributed to the fund's shareholders. Stock funds invest in stocks, which are shares of ownership in a company. The fund's shareholders benefit from the appreciation of the stock price over time, as well as from dividend payments. Balanced funds invest in a mix of bonds and stocks. The amount invested in each asset class varies depending on the fund's investment strategy. Index funds track the performance of a specific market index, such as the S&P 500. They are passively managed, which means that they hold similar assets to the index being tracked. This makes them a good option for investors who are looking for a low-cost way to invest in the market. Second, let's look at how mutual funds trade. Mutual funds trade differently than stocks and ETFs. Trading hours. Mutual funds trade only once a day after the markets close, while stocks and ETFs can be traded at any point during the trading day. Price determination. The price for the shares in a mutual fund is determined by the net asset value (NAV), which is calculated after the market closes. The NAV is calculated by dividing the total value of all the assets in the portfolio, less any liabilities, by the number of outstanding shares. Stocks and ETFs, on the other hand, have their prices fluctuate during the trading day. Counterparty. When you buy or redeem shares of a mutual fund, you are buying or redeeming them directly from the fund itself. When you buy or sell shares of stocks or ETFs, you are buying or selling them from another market participant. Fees. Mutual funds charge different fees for buying or redeeming shares. Third, let's look at the benefits of investing in mutual funds. Diversification. Mutual funds allow you to invest in a variety of assets, such as stocks, bonds, and real estate. This helps to reduce your risk by spreading your money across different asset classes. Professional management. Mutual funds are managed by professional investment managers who have the expertise and experience to make informed decisions about your money. Liquidity. Mutual funds are easily bought and sold, so you can access your money when you need it. Affordability. Mutual funds can be started with a small investment, making them accessible to everyone. Now, let's look at the risks of mutual funds. When you invest in a mutual fund, there are some risks involved. The prospectus for the mutual fund will detail these risks, but it is important to review the prospectus carefully so that you are aware of all the risks you may incur. Market risk. This is the risk that the value of a mutual fund's investments may fluctuate in response to broader market movements. For example, if the stock market goes down, the value of a mutual fund that invests in stocks may also go down. Currency risk. When a mutual fund invests in overseas securities, it is exposed to the risk of currency fluctuations. This means that if the value of the currency in which the securities are denominated weakens against the mutual fund's own reporting currency, the value of the mutual fund's investments will decline. Investment objective risk. This is the risk that your objectives will not be met by investing in the mutual fund. For example, if you are investing for retirement, you may not be able to reach your retirement goals if the mutual fund you invest in does not perform well. Liquidity risk. This is the risk that mutual funds won't be traded quickly enough in the market to prevent a loss or make the planned profit. The product may not always have a liquid secondary market, which might make it difficult to establish a fair price at the time of purchase or sale. Next, let's try to understand mutual fund charges and fees. The fees associated with mutual funds can vary significantly, and they can have a major impact on the performance of an investment in the fund. Mutual funds may charge fees when you buy or sell shares. These fees can be front-end loads, back-end loads, or 12b-1 fees. Front-end loads are charged when you buy shares in the fund. They are a percentage of the amount you invest. Back-end loads are charged when you sell shares in the fund within a certain time frame. They are a percentage of the amount you sell. 12b-1 fees are charged each year as a percentage of the fund's assets. They are used to pay for marketing and distribution costs. Load fees and expense ratios can have a significant impact on your investment returns. It is important to compare the fees of different funds before you invest. Actively managed funds typically have higher fees than passively managed funds. Actively managed funds try to outperform the market, while passively managed funds simply track a specific market index. Passively managed funds often have lower fees because they have lower turnover. Turnover is the rate at which a fund buys and sells its investments. Higher turnover can lead to higher fees. In some cases, it may be worth paying higher fees for an actively managed fund. For example, if you are investing in a foreign market that is difficult to access, an actively managed fund may be the best option. Ultimately, the decision of whether to invest in an actively managed fund or a passively managed fund depends on your individual circumstances and investment goals. Now, let's look at risk tolerance and investment goals. When choosing a mutual fund, it is important to consider your risk tolerance and investment goals. Risk tolerance. This is your ability and willingness to take on risk to earn a higher return. Investment goals. These are your financial goals, such as saving for retirement or a down payment on a house. Investors with a low risk tolerance should avoid aggressive mutual funds, such as those that invest in stocks or high-yield bonds. Instead, investors with a low risk tolerance should consider mutual funds that invest in safer assets, such as money market funds or government bonds or corporate bonds. Investors with a high risk tolerance may be more comfortable investing in aggressive mutual funds. These funds have the potential to earn higher returns, but they also have the potential to lose more money. Investors with a high risk tolerance should carefully consider their financial goals and risk tolerance before investing in aggressive mutual funds. It is important to remember that there is no one-size-fits-all answer when it comes to choosing a mutual fund. The best mutual fund for you will depend on your individual circumstances and investment goals. Lastly, let's see how to get started investing in a mutual fund with a brokerage account. When you are ready to start adding mutual funds to your portfolio, it is important to find a broker that offers low fees. Transaction fees are charged when you buy or sell shares of a mutual fund, and management fees are charged on a regular basis to cover the costs of running the fund. Look for a broker that offers no transaction fees and low management fees. Here are some examples of brokers that offer low fees for mutual funds. Fidelity Investments. Fidelity Investments offers over 3,400 mutual funds with no transaction fees. E-Trade. E-Trade offers no transaction fees for over 4,400 mutual funds. Charles Schwab. Charles Schwab offers no transaction fees for over 4,000 mutual funds. You can also consider using a robo-advisor such as Wealthfront and Betterment to manage your mutual funds. Robo-advisors are automated investment advisors that can help you build and manage a portfolio of mutual funds that meets your individual needs. Some robo-advisors charge no fees, while others charge a small percentage of your assets under management. Now that you understand better how to invest in mutual funds, I hope this video helps you in being one step closer to your financial goals. Please give a thumbs up on the video if you have enjoyed watching. If you have any questions, please Please leave them in the comments below. And be sure to subscribe to my channel for more wealth creation tips. I'd see you in the next video. Bye.